Hello, everyone. Welcome back to the channel. Francine, Ellie, Reef, Queen Bee, Mancheska, Black Widow. It's great to see you guys, ladies and gentlemen. There's a bit of an issue going on here. You know, if billionaires are taking their money out of the stock market and going long on things like Bitcoin and gold and cash, there's a problem going on here. And that problem most likely stems to the fact that, well, the S&P 500 is being propped up by 6 stocks. These 6 stocks account for over 30% of the entire S&P 500 at this point. Meanwhile, Palantir was recently added to the S&P and continues to hit new all-time highs. It surged over 160% year to date, and it trades at one of the richest valuations ever seen of any stock. 254 times earnings and 39 times sales. This is something very similar to what we're seeing with Apple, Nvidia, Microsoft, Google, Amazon, and Meta, the top 6 stocks on the S&P 500. What do we have here? Well, basically, the Bank of Canada has cut rates by half a percentage point, but the last 3 times that it has cut rates by 50.5%, there was massive economic emergencies. In 2001, obviously, September 11th, and the dot-com bubble crash. 2008, the GFC, the global financial crisis. 2020, the scamdemic. And, 2024, it's probably nothing. The stock market concentration right now is insane. And when you look at the 10 biggest companies accounting for 18% of the value of the global equities market, this is more than ever in over 50 years. The top 10 U.S. companies now account for 18% of the global stock market capitalization. I already told you guys that 6 stocks account for 30% of the entire S&P. But the top 10 U.S. companies account for 18% of the entire stock market capitalization of the entire world. That's the most we've seen in over 50 years. And to give you a little bit of perspective, even at the massive bubble we saw during the 2000 dot-com crisis, the top 10 firms' weight was 14% in comparison to 18% today. And at the same time, the top 5 U.S. companies reflect 15% of the global stock market's value. That's the most ever since the data was began tracking in the 1970s. Eddie, cheers, my friend. I see you guys and girls. Take a look at the September existing home sales. September existing home sales. They fell by 3.5% year over year to the lowest level we've seen since the last recession of 2010. Obviously, the one in 2020 was artificially created by the federal government, so there was no drop in existing home sales at the time because of the massive amount of quantitative easing, which means money printing by the Federal Reserve and the United States government as well. Existing home sales fell to an annualized rate of 3.84 million, which is the slowest since October of 2010. First-time home buyers made up 26% of all purchases, which matches an all-time low. And the median sales price rose 3% in September compared to last year's data. And at the current pace available, inventory would last 4.3 months. That's the most inventory we've had in over 4 years. This is obviously because the housing market is stalling. Huge shout out to the Kobesai letter for this exceptional post. And great charts here as well. Let's take a look at Bravos Research. This is another banger right here on the S&P 500. The S&P 500 has surged 40% in just 1 year. But that's not all that great when you consider inflation numbers and what precious metals have done. More on that shortly. In 1929 and 2000, the same thing happened. The S&P 500 surged over 40%. Is history about to repeat? Asks Bravos Research. Well, lately, the stock market melt-up has been popping up more frequently in news, and some people are getting really excited about that. Looking at the S&P 500, it's very obvious that the market has been in a steep uptrend. And they always say, don't fight the Fed, similar to what's going on now. There's been a 40% return since October of 2023 through today. A 40% yearly gain in the S&P has only happened 15 times since 1927. Here's the chart for that. These rare occurrences are very significant moments in stock market history. And what we're seeing right now qualifies as a melt-up, without a doubt. But can they be sustained, or will they lead to a market crash, much like what we saw in 1929 and 1999? Now, that's no guarantee that things are going to end badly when you look at just the charts, because history shows that not all melt-ups end badly, right, guys? But today's market has some ridiculous warning signs. And this indicator, multiple indicators, I'm about to show you 3 different that prove every single time when they happen, a recession occurs. And that's where we're at right now. Now, understanding market valuations is obviously tough, says Bravos Research, and they give us this awesome chart to check it out with, because the S&P 500 has a long history of only moving up. But over time, stock prices rise, largely driven by increased earnings. And this can make it seem like the market will always lead higher. For instance, a home that costs $12,000 in 1960 now costs $400,000. A loaf of bread was 2 cents in 1963 and now is over $2. That's exactly what we're talking about in this case. Here it is, right here. Didn't open up the right one. What we're seeing here is inflation, and times have changed, and it wouldn't make sense to compare today's market to what happened 100 years ago or even 50 years ago. Corporate profit margins have expanded significantly due to technological advances, and profit margins have risen by over 30%, not 200%, as the market would make you want to believe. During recessions, profit margins can sharply contract. Profit margins will shrink substantially over this coming recession, one that over 60% of Americans believe we're already in, because they're the ones that actually see it. A recent survey of over 2,000 Americans found that over 60% of people believe that we're already in a recession. Today's market is only about 20% more profitable than it was in 1999. In 1999, valuations hit a profit-to-earnings ratio of 43. They have not increased along with the price of the stocks. The valuations are at record highs. But one thing that has gone up significantly higher than the S&P 500, precious metals, silver, gold. We've showed you this on this channel for the last 3 years. Silver spot price is up 57.7% in the last year compared to the S&P's 40%. And much higher compared to the devaluation of the dollar in the last year as well, due to the invisible tax known as inflation. Serdar brings up a great point that a recession is slowly working. People have lost their money due to this inflation, and it's very, very much called the silent killer for a reason. One would be heart attacks. The next would be the recession, because it destroys people's bank accounts, jobs, livelihood, real estate values, and lives. Gold is up 49.2% over the last year, even though it was significantly higher just a few days ago. Same as silver, $33.89. And you guys know, if you've been watching this channel for a while, we were telling people back when gold in 2022 and even 2023, when silver was between $17.50 and $22 an ounce, that we're going to see some massive gains on these equities, particularly precious metals. That's the reason that billionaires like Paul Tudor are holding such a vast amount of it. He says the U.S. government's debt and deficit issues aren't going anywhere, no matter who wins the presidency next month. And he's right, because the Federal Reserve and the U.S. Treasury, led by the massive overspending by Biden and Harris, has reached a point of no return. There is no coming back from giving trillions of dollars, hundreds of billions of dollars to illegal immigrants and other foreign nations. Meanwhile, avoiding what's currently going on here in the United States. Paul Tudor Jones says the U.S. will need to inflate and outgrow its debt burden in a recent CNBC interview just a couple days ago. And he personally recommends owning a basket of gold, Bitcoin, commodities, and NASDAQ, and staying away from fixed income. I don't even know how I feel about his recommendation of NASDAQ personally, because we all know how heavily valued and weighted some of these stocks currently are versus the S&P. Again, 6 companies make up 30% of the S&P. The top 10 U.S. companies make up 18% of the entire global stock market capitalization. One of the indicators, Baby UFO tells us that bread is $7 to $9 on the Big Island. Wow, my friend. That's huge. Absolutely insane numbers. Let me zoom in for you guys just a little bit here so you guys can get a better idea of what's going on. This is the Sahm rule recession indicator. Now, SAHM in this case does not stand for stay-at-home mom. But I will zoom in just a little bit for you guys so you can get a better idea of what we're talking about here and what we're working with. This indicator was created by Claudia Sahm, and it has never, ever failed at indicating when a recession is about to begin. Never. It has properly, accurately indicated 9 of the last 9 recessions. As you can see here, the Sahm recession indicator signals the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more relative to the minimum of that 3-month average from the prior 12 months. Now, she came up with this as part of her dissertation, I believe for her economics PhD. And when you look at it right now, that doesn't look so bad, right? This is where the trick comes in. It goes up many times and always comes back down without a recession, but only when the increase is less than 0.5%. As you can see here, it went up 0.17, came back down, recession averted. But every time it's gone up by more than 0.5, we have had a recession. And it has properly indicated that. Let me pull this a little bit closer to you guys so you can see. Look at what happened in 2000, 2008, 2020. Unemployment through the Sahm indicator correctly indicated the recession each single time. And to make it even more obvious, we'll zoom it in here to today. This is the last 2 years. It looks a lot more obvious when you zoom in, right? It jumped multiple times here, and due to the changes in the actual qualification for being considered unemployed that have been recently implemented by the Bureau of Labor Statistics, this was not seen sooner. But now the unemployment rate is so high that even with those changes by the Bureau of Labor Statistics, we have greatly exceeded the 0.5 mark. It was exceeded in July of 2024, August 2024, and remains exceeded in September of 2024. Now let's pull out right here. We can see it remains elevated and see what happened in 2020. Let's zoom into that. You can see the number did a very similar thing. Went straight from 0.2 up to 4 because those were artificially created. But let's look back at 2008 and what happened there. And we'll zoom into that even further. And you can see it was a much more gentle growth into the 0.5 range. Actually, it was a much quicker jump, and we are seeing a much more gentle growth into that range now. But once it exceeded it in February of 2008, it only took a few months for that number to really take off and the amount of unemployed people to skyrocket. And let's go back to 2000, and we'll look back at what happened during the 2000 dot-com bubble as well. Went up to 0.1, came back down, but when it went back to 0.5 a few months later, it only took 2 months to get to 0.77, 2 more months to get over 1.17, and eventually peaking at 1.6. And I'm not going to make this any different in size, but I'm just going to scoot it over and show you what we're looking at today. When you see that we've been looking at an increase in this since April of 2023, it has not come back down to zero. It has exceeded that 0.5% mark. It proves that we are entering a recession, much like it has the last 9 out of 9 times that this has occurred. And these gray bars are not input before or during the recession, guys. Keep that in mind. I saw your comment there, Black Widow, and you're absolutely right. Look at when the gray bar actually becomes shown on the government data. Look at how high the unemployment actually has to be before they retroactively go back and insert that bar to show you that there was a recession. When it goes from 0.5, way over 1%. That is when they always go back in after the fact, going back many, many decades, to input that bar. And that's very similar to what we're seeing right now. In about 6 to 12 months, we will see that bar on the Sahm Rule recession indicator for the Federal Reserve Economic Data website by the St. Louis Fed. There are a lot of indicators pointing at this, not just one, not just two. And this is something we need to talk about. A guy by the name of Porter Stansberry on X posted this. The 1970s lost decade for investors. Everyone has a plan until they get punched in the face, according to Mike Tyson, right? And that's the situation that Jerome Powell is in right now, with the bond market punching the Federal Reserve in the face. Because they expected to lower borrowing costs, right? So Jerome Powell cut overnight interest rates by 50 basis points on September 18th. And yields on long-term bonds, like the 10-year U.S. Treasury, are screaming upwards, doing the opposite of what the rate cut said should happen. This wasn't supposed to happen. Well, in normal environments, it's not supposed to happen. When the Fed is in sync with the market, long-term borrowing costs follow the path of overnight lending rates that the Fed sets. But when the Fed makes a mistake, an error in policy, like this rate cut, even though inflation is running hot, much higher than the Fed's target rate, the market will fight back. And that's exactly what we're seeing right now. We've seen this movie already, and it doesn't end well. In 1971, despite inflation being over 4%, which, just so you know, if you use the same 1971 calculation today that you did back then, inflation is actually over 5%. So in 1971, despite inflation being over 4%, the Federal Reserve Chair, Arthur Burns, cut interest rates in order to boost the presidential prospects of Richard Nixon ahead of the 1972 presidential election. And that's exactly what Jerome Powell did right now in hopes of helping the Democrats win this election, which I don't think that's going to happen. And by cutting rates with inflation running hot, the Federal Reserve allowed price pressures to become entrenched in the U.S. economy. That means it would not bring down inflation sufficiently. American workers were scared of the continuous price increases cutting into their wages and began demanding higher and higher pay increases. And that's what needs to happen right now. This fuels a self-reinforcing wage price spiral that unleashed a decade of double-digit inflation, crippling interest rates, and stagnation in our economy. This is called stagflation. Stagnation of our economy and continuous inflation is inevitable because of what we're seeing right now. As you can see, the S&P 500 ended 1979 at the same price that it did 1968. So we might be seeing all-time highs on the S&P 500 right now. Absolutely. But we might also see those same all-time highs in a decade. In 2034, we might be seeing the exact same all-time highs that we're seeing right now because the market has to pull back significantly from where it was at the time. Look at this chart on my screen. Nobody made these numbers up. These were the exact same numbers that were going on between 1968 and 1979 that we're seeing right now. The same inflation data, the same move by Jerome Powell, cutting rates before a presidential election, even though the Federal Reserve had not reached their target. We're on repeat, and this movie does not look good. It took the Volcker Fed bringing overnight interest rates to over 20% to finally bring inflation back down in the 1980s. Look at what happened in 2024. The Federal Reserve cut rates here at the red circle. And what happened to 30-year mortgage rates? Did they go down? No, absolutely not. They have surged. And and this means that higher inflation comes next. And again, like I said, it took Volcker 20% interest rates in the 80s to finally bring inflation back down, but not before we saw double digits. That is what you should be getting ready for. That is why things like silver and gold are so important. That is why silver is up 57.7% in the last year. That is why gold is up 49.22% in the last year, greatly outweighing any gains that we've seen in the S&P. Because even though the S&P is up 40% in the last year, the S&P is going to come down significantly more than silver and gold will. As of, in the interim, in the time it took from 68 to the 80s, U.S. investors suffered massive losses for an entire decade because of the negative inflation adjusted returns in both stocks and bonds, right? Remember, they have to be adjusted for inflation. The S&P 500 index ended 1979 at the same price level that it was at in 1968, 11 years prior. And that's what we're seeing right now. We're seeing 1968 price levels. And in 11 years, we're going to see the same fucking price levels. So after accounting for the rampant inflation that pushed prices up by over 50% back then, look at your grocery prices, your car insurance prices, your home insurance prices, and everything else of the like, we're seeing the same thing. The movie's on repeat. After accounting for the rampant inflation that pushed these prices up by over 50%, stock investors lost half of their money in inflation-adjusted real terms. Bond investors didn't do much better, with the 10-year Treasury logging losses of 3% per year after adjusting for inflation, or roughly a 30% loss in purchasing power over that decade. That was the worst decade of investor returns since the Great Depression. And we are looking at the same thing right now. So, unlike stocks, which can often temporarily increase, there's economic gravity here during periods of rampant enthusiasm like we're having right now. People think the market can only go upwards. And that is a fallacy that occurs during every stock market downturn. The bond market is a much, much tougher customer. And that's obvious when you look at the interest rates doing the opposite of what the Federal Reserve cutting rates did. Because for fixed income investors, it's not a good thing. It couldn't be the worst thing. It's the worst thing that could possibly happen. Inflation is enemy number one for fixed income investors and people on a fixed income. The silent thief is inflation, and it can transform what appear to be positive nominal adjusted rates into negative real inflation adjusted returns. And Porter Stansberry's post here really indicates exactly what we're seeing. You think things are looking up, but when you account for inflation, it leaves you in a negative. And prematurely lowering the short-term interest rates before reducing inflation to acceptable levels, Jerome Powell is repeating the same fatal mistakes that Arthur Burns' Federal Reserve did in the 70s. And this will stoke fears of entrenched inflation because inflation is here to stay. If you haven't yet seen my video with PhD economist Dr. Marco Metzler, I did that last month. You can go check it out right now. And you will learn even more directly from a PhD economist who accurately predicted the downfall of Evergrande. Bond investors seriously remember the 1970s and the fears of the persistent inflation that we're seeing today that crushed their real returns. Means that they're now demanding a larger margin of safety. And this sends borrowing costs shooting to the long end of the curve, like the 10-year Treasury rate. The 10-year U.S. Treasury is one of the world's most important lending benchmarks, which determines the borrowing costs throughout the entire global economy. And this includes things like the 30-year U.S. mortgage rate, where yields were dragged significantly higher with the 10-year Treasury, spiking by 50 basis points in the wake of Powell's recent 50 basis points cut. This is a huge problem for the 99%, specifically because of the higher borrowing costs. And this contributes to what? More inflation. This is particularly true in the housing market, where higher mortgage rates feed directly into a higher cost of home ownership, because higher mortgage rates make you pay more for the same house, even at the same value. The average monthly payment now on a U.S. priced home is over $2,700 per month, average. That means it now requires an annual household income of around $106,000 to own the average home in America, up from just $59,000 in 2020. That's a nearly 100% increase in just 4 years under Biden and Harris's Democrat Party. Not surprisingly, the costs of actually having a home were one of the biggest gainers in the September inflation report, which spiked by 4.9% year over year and running well ahead of the headline inflation at 3.3%. Hence, Jerome Powell made a big fucking mistake. Meanwhile, the Fed's rate cutting campaign was supposed to support economic growth in the United States, and it's not. It is absolutely backfiring. It is encouraging more people to borrow at a higher rate, and it's doing the opposite. We can see, in fact, that the new mortgage rate applications have fallen off a cliff. New mortgage applications are down 17% in the latest weekly data. Mortgage refinancing fell even more, 26%. This means that even though there is still some demand in the housing market, supply is increasing, as I told you guys earlier. Supply is at higher levels than it's been in the last 5 years. This means that more homes will come on the market. Fewer people are applying for mortgages, particularly in the South and in other places like Idaho, where there are more new construction homes. Housing prices will continue downwards. In other places where there is less new construction, such as the Midwest and the Northeast, housing prices continue to increase that will continue until there is more supply than demand coming on the markets. Doug says it's a good thing that we'll have some excellent buying opportunities too. Why not through lit exchange? That's absolutely true. Gold and silver are exceptional buying opportunities, as is private equity. And for the first time in the history of the world, you have the opportunity to own an upcoming stock and crypto brokerage. Lit Exchange is the only stock and crypto broker in the entire world that has ever launched a Regulation C via the Jobs Act filing for retail investors to be able to own equity. Because most stock and crypto brokers, not most, all stock and crypto brokers go directly to hedge funds and family offices for money. Whereas Lit Exchange is the only one that has ever done this in the history of the world. We are leveraging the U.S. Jobs Act under former President Donald Trump to offer this Regulation C filing in which you can own equity in the company, as well as pre-IPO buyers' rights of additional shares and many others. So that when we IPO in the coming years on the New York Stock Exchange or on the NASDAQ, you will then have the opportunity to sell off your investment for what we believe to be very significant potential profits. And with that, I'll leave you, my friends. Make sure you check out the link there. This video is sponsored by Lit Exchange, upcoming stock and crypto brokerage. And over 200 retail investors have already invested over $400,000 in the Regulation C campaign. So you can become a founding investor and have a chance to invest in more than just the S&P 500. Cheers, my friends. You guys really keeping the heat up with the chat, and I love it. I could not be more pumped about it. The Democrats, one of our chatters here says the Democrats are clearly sending their worst candidate to get everyone to vote Trump so they can blame him for the incoming economic crash on liberal media. Cheers. Pam, I appreciate you. Black Widow, Serdar, Maynard. Thank you, ladies and gentlemen, for being here with me. Let's do another live stream tomorrow. I usually don't do Friday streams, but I do think that it's going to be important to have another one. This one tomorrow is going to more specifically be related directly to heavily shorted equities like silver, gold, GameStop, AMC, etc. And let's talk more about that tomorrow. Cheers, guys. I wish you peace and wealth. Make sure you're properly hedged.